Most people shopping for a home make the same mistake. They go on Zillow, they find a house they love, they scroll down to that mortgage calculator, they do that quick calculation, and they believe that's the whole picture. Then they apply for a mortgage, receive the loan estimate, and that number is $300 higher than what they expected. Today, I'm going to tell you why. I'm Jeremiah Seldo, the mortgage medic with Hook and Ladder Lending. I'm a loan officer and a paramedic with almost 20 years in emergency services. I'm going to tell you something I tell patients on scene all the time. If you understand what's going on, it's a lot less scary. Today, we're breaking down exactly what makes up a monthly mortgage payment, every single piece of it. And then I'm going to show you 5 levers you can pull to lower it, some before you close, some after. Let's go. Mortgage lenders and realtors love acronyms, so let me give you the most important one you'll hear in this process. PITI. P-I-T-I. 4 letters, 4 things. All of them show up in your monthly payment. Most buyers only plan for the first 2. P, principal. This is the part of your payment that actually pays down the balance of the loan, the amount you borrowed. If you put down 10% on a $350,000 home, you borrow 315%. In every payment, some portion of that goes towards reducing that number. Here's what nobody tells you about the beginning. It's almost nothing. In the first few years of a 30-year loan, your payment each month might be $400. We'll talk about that in a second. I, interest. This is the lender's fee for letting you borrow their money. It's calculated as a percentage of your remaining loan balance, which means in the beginning, when your balance is highest, interest takes the biggest chunk of your payment. Over time, as your balance shrinks, more of your payment shifts towards principal. This is called amortization. T, taxes. Property taxes. The county you buy in charges you an annual tax based on your home's assessed value. Instead of letting you forget about it until a giant bill shows up, your lender typically collects it from you in pieces every month and holds it in an escrow account. I, insurance. Specifically homeowners insurance. Your lender requires you to have it because if your house burns down or the tree falls through the roof, they want their collateral protected. Same as the taxes. Your lender splits it up into 12 payments throughout the year. But here's where it gets interesting. Depending on your situation, there are 2 more pieces that can show up. The first one is PMI, private mortgage insurance. On a conventional loan, if your down payment is less than 20%, your lender is going to require this. What is PMI? It's an insurance policy that protects the lender in case you stop making your payments. You pay for it, but it covers the lender. That might sting a little, but it's also the reason why you can buy a home with 5% down instead of waiting years and saving up to 20%. This is like the cost of entry. The good news is that it's not permanent. On a conventional loan, once you hit 20% equity, meaning your loan balance is 80% of the home's value, you can ask for it to be removed. Once you hit 22% equity, lenders are required to remove it automatically. On some other loan types, mortgage insurance works differently, but that's a video of its own. The second one is HOA dues, Homeowners Association. If your home is in a planned community, condo building, or certain neighborhoods, you might have HOA dues. Depending on the property, these can be minor or they can be significant. Some lenders will roll this into your monthly payment, others won't. Either way, it needs to be part of your total housing budget. Now that you know what's in the payment, let's talk about what you can do about it. 5 ways to potentially lower that monthly number. Some before you close, some after. Lever 1, your down payment. The more you put down, the lower your loan amount, which means lower principal and interest, and potentially eliminating PMI entirely. On a conventional loan, 20% down means no PMI at all. But here's the thing most buyers don't run the math on. Sometimes it makes more sense to put less down, keep cash in the bank, and pay PMI for a few years while your equity builds, than to drain your accounts to hit 20% and become potentially house broke. That trade-off is worth having a real conversation with me. Lever 2, eliminating PMI. If you're already in a home and paying PMI, this one's worth looking at. If your home's value has increased, or if you've been making payments consistently for a few years, you may already be at or near that 20% equity threshold. You could potentially request removal without refinancing. That savings, depending on your loan, can be meaningful each month. Lever 3, shopping your homeowner's insurance. This is the one people almost never think about. Your insurance premium shows up in your payment every month, but you can shop that policy. Getting quotes from multiple providers could potentially reduce your monthly payment without changing anything about your loan. Nobody's going to send you a letter reminding you to do this, but that's why I'm telling you now. Lever 4, a rate buy down. This is a strategy where typically through seller's concessions, builder incentives, or sometimes lender credits, points are paid upfront to reduce your interest rate. A lower rate means a lower principal and interest payment. Depending on the structure, this could be temporary, like a 2-1 buy down where the rate is reduced for the first 2 years, or a permanent buy down. Whether this is the right move depends on how long you plan to stay in the home, where rates are, and what concessions are available to you at the time of purchase. It's a tool in the toolbox, not a default answer. Lever 5, property tax appeal. Your property's assessed value, which determines your tax bill, isn't always accurate, especially in markets where values have moved fast. If your home was assessed too high, you may have the right to contest that assessment and potentially reduce your annual tax bill, which means your escrow drops and subsequently your monthly payment drops. In Texas, you have the right to protest your property tax appraisal every year. Most homeowners don't know that, and even fewer do it. That's 5 levers. Not all of them apply to everyone, and the right combination depends on your specific situation. But now you know they exist, which means you can ask the right questions. Here's the deal. A confused borrower makes uninformed decisions, and uninformed decisions cost money. I broke all of this down today because when you are applying for a mortgage, you deserve to understand what every number means before you sign anything. If you want me to run your actual numbers, your real PITI or PITI, based on real homes in your price range, that's what I do. My contact info is in the description. It's only a conversation, not a commitment. No pressure. If this was helpful, please like and subscribe. I put out videos like this every week. And share it with someone who's about to start house hunting. It might save them a significant amount of confusion and potentially a significant amount of money. I'm Jeremiah Seldo, the Mortgage Medic. Reach out for a free loan consultation.